The following podcast was recorded on Thursday, September 15th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by Sam Rines of Arbor Data Science. Welcome, Sam.
Good morning, Kristen.
We're happy to have you here today, and we want to talk today about tightening monetary policy and its effect with zombie companies. Zombie companies, by definition, do not earn money, have slow growth, highly levered, and need to borrow to keep going. The need to access easy credit and their ability to refinance are key. What happens when interest rates start rising and we're in a tightening cycle?
This is where it gets really interesting, right? Because there's a lot of, call it sentiment, that quantitative easing and really cheap money create zombie companies and kind of keep them going longer than they should, right? Sometimes we're of the opinion that you should just let things die. Creative destruction, et cetera, et cetera. What happens when you begin to tighten monetary policy and then continue to do it is you begin to take away the ability of companies to refinance their debt at cheaper costs. Or if they have, call it lines of credit or short-term debt that resets very quickly, it almost instantaneously pushes their cost of credit much higher. And that causes significant problems for some businesses. The interesting thing is it's typically pretty simple, right? When you have, call it a monetary policy that is going, call it easier, and you have the potential for a significant easing cycle, you tend to want to buy the zombie companies or the non-earning companies of the stock market. And when the Fed is tightening policy, you tend to want to sell them. It's never that easy, across the board, but that tends to be exactly what you want to do.
What industries are most at risk?
Ooh, the interesting part about figuring out who's most at risk is that it's different every time. There was call it the 2014 to 2020-ish period where a lot of zombie companies were energy related, right? They were oil and gas companies that smaller ones, or oil and gas service companies that had a lot of debt, and oil prices collapsed and they weren't earning money, right? So those were the zombie companies of yesteryear. This time around, it would have been a pretty bad idea to consider those the zombie companies that you wanted to short or sell into this cycle, right? They have benefited from much higher commodity prices. So I think that's an interesting example of how it's difficult and not, in every time is the same time type of deal. It's this time around, it's probably going to be some of the, call it mortgage REITs and things like that, that are highly levered and have business models that are heavily, call it tied to interest rates and refinancing capabilities. But generally, it's going to be the non-earners in the tech space that have some debt and aren't going to be able to find their funding as easily as they could before. So I think that's really the place to look this time around.
And if you take a look back kind of pre-pandemic and where we're at now, what was the biggest impact at the time of the pandemic on zombie companies?
Oh, this is interesting, right? Because one of the larger components of zombie companies is biotech. And when you had, call it 2020 and 2021 and very early 22, that was a boom for biotech IPOs. And so every time you had a biotech IPO, you basically had a new zombie company because they tend to borrow to do research, don't make money until they get catalyst, right? An FDA approval, or get bought by a much larger company, or have an injection of cash from a much larger company. So you had a significant tailwind there to the overall zombies. You also had a significant number of businesses that, while they survived and they'll be fine in the long run, they weren't earning a lot of money during the lockdowns, right? You had restaurants, you had hotels, things like that, that probably weren't long-term zombies, but they were, they were short-term zombies until they found the cure.
And you touched on this before, but how do business models really complicate the analysis?
Oh, it gets really, really complicated when you dig into it, because I think it's worth remembering that a lot of these companies have tremendous depreciation and amortization shields from taxes. So if you think of a shipping company, for instance, that owns boats or owns their own fleet of boats, those companies tend to not look like they're profitable at all and tend to be kind of scary. But in reality, they're writing off a tremendous amount of depreciation against a very large asset base. The same goes for a number of the zombie companies that have been some of the best performers this year, which are oil services companies. They have a tremendous amount of capital that they've spent in order to build out a, call it a fracking fleet or whatever part of the business they're in. They get to depreciate that, and they get to accelerate the depreciation in certain cases. That makes them look like zombie companies, but in reality, they're, underneath the surface, they're actually, their cash flows look fine. So I do think that there's a depreciation aspect that needs to be taken into account here. And a lot of companies that look pretty profitable probably are really zombie companies. If we look at something like a Kohl's, for instance, right? I mean, Kohl's, looks like a fairly profitable company. It wouldn't fit into the mold of a zombie company, but at the end of the day, they can't sell themselves and have had a tremendous amount of problems trying to find their niche between, call it Old Navy and Target, and that just has not worked out well for them.
So how do companies get out of this trap? Will we see a wave of bankruptcies or collapses in the near future?
It's hard to say that we'll see a wave of bankruptcies, particularly for companies of this size. They typically have access to some form of capital to keep them going, whether it's a line of credit from a bank or something along those lines. I think it's very important to watch whether or not we begin to see credit markets freezing up. Because if you can access credit, even if it's at a higher rate, you can still survive, right? You just get to be, you're more of a zombie, but you survive. You're walking dead, not dead. That I think is a really important part of it. It's really a question of, unless credit markets seize up and stop lending, they'll be able to roll their debt. It'll just be at a much higher price and probably make them worse off into the future.
So would it be much harder then for the smaller to mid-cap size companies?
Oh, yes. Small and mid-cap companies are the ones that are most exposed to this. They tend to have much shorter term debt. They don't have access, they don't have Apple's access to credit markets and debt markets. What they typically have are bank loans and much shorter revolving lines that reset very quickly as the Fed begins to raise rates. So if they've pulled on those lines, their borrowing rates have gone from 1% and are heading north of 4% very shortly.
And Sam, what's the impact on the overall economy?
It's difficult to say. And I think this is call it the most important part. A lot of employees, sit within these zombie companies. And if you begin to have credit market seize, that's going to be a direct effect on employment. Again, I don't think you're going to see it until you really have the credit markets seize up, and we haven't seen that yet. But it would happen through the employment side. You'd probably see the unemployment rate begin to tick higher, initial jobless claims begin to tick higher. You've already seen some rumblings out of Google and Zwillow. Those layoffs are going to begin to bite as we move forward, but the question is, how big are they? And until you begin to see something, call it north of 300,000 for initial jobless claims, and we haven't seen that yet, until we begin to see those larger numbers, it's just really difficult to say that the tightening has really gone through to the labor market yet.
In summary today, what should we be watching for next?
Credit market seizing up. I think that's really, really the next piece of the puzzle, not just for the zombie companies, but also for the broader context of unemployment, how much the Fed's tightening is really doing on the ground, and how to judge that against a benchmark. That's where I think we're going to really need to consider what's the next step from the Fed. That would be problematic. So I'd be watching credit markets and whether or not they continue to be open. I mean, yes, rates are higher, but you can borrow. If that window begins to close, I think that's going to become a much more problematic scenario for the U.S. economy.
Sam, thank you for your thoughts today, and thank you everyone for joining us. If you do have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, have a great day.